I'm Charlotte McLeod with investingnews.com, and here today with me is Rick Rule, proprietor at Rural Investment Media. Thank you so much for being here. Always great to be catching up with you.
Thank you, Charlotte. It's great to be back with you.
Of course. We have many topics to get through today, but where I thought we could begin is with the Rural Symposium, which is coming up very quickly, I believe July 6th to 10th. So if we can start there, and I wonder if you can share the key things that you would want investors to know who may have been before or haven't been before.
Well, it'll be a rare opportunity to see Charlotte McLeod live. She's been a great feature supporting our conference and at our conference for a long time. Moving on from that, we hit the high points first. The conference is about 30 years old. I'm told it's the longest continually running natural resources investment conference in the world. So we've done a few things right. We've tried to make it a little better every year. And if you do that for 30 straight years, it gets pretty good. It's interesting how we do that, Charlotte. We, at every conference, poll our attendees as to what we could do better. I found, not surprisingly, that rich people are very generous about telling you how you can serve them better. So we've incorporated a lot of suggestions from attendees over 30 years, and we've come up with, I think, a pretty good conference. What's different? Let's view a few things. The first is that our attendees ask us for a different big picture view than they would get other places. They don't want rehashed garbage from Fox or CNBC or the CBC. So we give them, the Daniela Di Martino Booths, the David Stockmans, the Nomi Princes, people who tell you about the world the way it really is rather than the way the CBC or Fox would have it. And that's important. When we're done with that, we try to explain to you how to turn that information into money in natural resources. And to that end, we have investment analysts and portfolio managers who've been active in resource markets for 40 years, not some young pup newsletter writer who made his or her reputation the last 18 months of the bull market, but rather people who have for 3 or 4 decades been tested by good markets and bad and the test of time. And investors have responded well to that for 30 years, that sort of voice of experience, voice of reason, voice of ration. Moving on from that, we vet every single exhibitor on our floor. We turn down more exhibitors than we admit. Specifically, if it's a public company exhibitor, their shares have to be owned in the accounts of the conference sponsors. Pretty tough test. At most conferences, the qualification to be an exhibitor is a pulse and a check that cashes in reverse order of importance. There's no guarantee, Charlotte, that because I own a company's stock that the stock price goes up, but there is a guarantee that I've studied it, that I vetted it. And no other conference has that precondition. Moving on from there, because we only have 4 days in the conference to teach you a lot about natural resource investing, and because 4 days isn't enough time to cover the topic, we cheat. We interview every public company exhibitor before the conference. We post those interviews at the Rural Investment Media YouTube channel and at the Rural Classroom. That allows you to review all of our exhibitors, should you care to, before you come to the conference. That way you arrive at the conference better able to allocate your time and attention in 4 days. But that's still not enough. So we record every single second of the proceeding, including all of the breakout sessions, so that you can attend sessions that you couldn't otherwise have attended and refresh your memory about the conference over the ensuing year. We do a couple of other things that are important to you, I think. The most important of which is that we offer you an unconditional money-back guarantee. Nobody else does this. Whether you attend the conference live or via live stream, if you think at your sole discretion for any reason whatsoever that you didn't get your money's worth, you get your money back. No other conference sponsor on the planet has enough confidence in their content that they give you an unconditional money-back guarantee. Now, we've done a good enough job for people that over 30 years, we've had to refund about 0.1% of the tuitions that we've charged. But that money-back guarantee is your guarantee that we have confidence that our content can and will make you money in natural resources.
Well, definitely a lot of reasons to attend. We will have links in the video description for people to check out. And as you mentioned, I will be there. I'm really looking forward to it. I'm looking forward to seeing you and, of course, all the attendees. So excited to have that coming up very soon. And I want to make sure we talk about the circumstances that we're in right now as we approach the symposium. For you, what are the key concerns right now for resource investors? What's really on your mind right now that you think people should be thinking about as well?
First and foremost, the war. What goes on in the Straits of Hormuz changes a whole bunch of things. If that conflict doesn't end, probably if it doesn't end this week, we move from a period where oil prices have risen in anticipation of a shortage to oil being rationed by price in many markets. We don't feel it in North America, Charlotte. North America as a unit is energy self-sufficient. Both the US and Canada are oil and gas exporters. So we don't feel the shortage. We feel the price at the pump because we operate in world markets. But much of the rest of the world is experiencing and will continue to experience real difficulty if the war doesn't end. And investors understate the importance. You're told by the CBC that 20% of the world's crude moves through the Straits of Hormuz. That's less important than the fact that 55% of the world's export crude flows through the Straits of Hormuz. If you're a country like Japan that's 80% reliant on that crude, uh, what is of interest to Americans becomes existential for the Japanese. So that's one thing. If this thing doesn't end very, very, very quickly, we will get another oil shock. And the impact of the oil shock is something that people need to consider. Energy prices act as a tax. As you know, Charlotte, I believe all taxes are bad. But the truth is that the money that now goes to energy normally provided liquidity for other areas of the economy. That capital will be less scarce. It will impact consumer spending. It'll impact a lot of stuff. And the potential that this oil price shock has to send us into a synchronized global recession or worse is something that needs to be considered. I'm not calling this a definitive, but something has changed in the last 90 days, and we need to think about what are the possible ramifications of that. And a global economic slowdown is certainly one of the ramifications of that. We've seen, I think, one implication of that in higher U.S. interest rates. What had been slated to be a disastrous $2 trillion a year deficit has become a 2.6 or $2.7 trillion deficit. And the consequence of that is that investors around the world are asking for more compensation to lend the U.S. government money, which has driven bond yields up. Perversely, in the near term, this weakness by the U.S. government, the fact that it has to pay more, is good for the dollar. I know it's really perverse, but the higher interest rate makes the U.S. dollar more attractive relative to currencies that haven't increased the interest rate. And the ramification of that is that in the very near term, commodity prices, which are denominated in U.S. dollars, have plateaued. I believe this is the calm before the storm, of course, but people need to understand that the stronger U.S. dollar in the near term, as a consequence of higher U.S. interest rates, will moderate, again, in the near term, demand for commodities. That will, I think, Charlotte, um, cause people to be less able to appreciate the inevitability of higher commodity prices over the 5 and 10 year time frame. And we will talk a lot about that dichotomy and how to take advantage of it at the conference.
Definitely. We've got a lot of directions to go in here. I want to stick with oil because we've been talking about oil quite a bit for the last several interviews, I think, that we've done. And earlier this year, you'd mentioned that it's a story that is inevitable but not imminent. So for you now with the war, is this becoming more of an imminent story?
Yeah, Charlotte, I wish I could have forecast that there would be a war. Then I wouldn't have said imminent, but not imminent. When I was talking to you about oil, particularly in January, oil was hated, and you've come to know, Charlotte, I love hate. Uh, I love circumstances where the price of something has to go up. I didn't understand how fast the price could go up because I didn't think we'd be dumb enough to go to war, but we were. And so the set of circumstances that I thought would occur in 2029 occurred in 2026. In the near term, the oil price is entirely a function of the war. If the war ends, likely the risk premium and the supply premium built into oil evaporates, and you'll see a fall in the oil price from circa $115 to something like $70 or $75. In the event that the war doesn't end, all bets are off. I don't know where it goes. I don't know how much people pay. What folks need to understand is that the oil price rise was inevitable. It was inevitable because, as we talked about in January, you and I, the oil industry has been underinvesting in terms of sustaining capital in excess of $1 billion a day. Never mind new project investments. This is sustaining capital investments. If you do that, it doesn't necessarily impede your ability to produce in 26 or 27, but it does in the out years. And that problem's got worse with the war. Worse because obviously the Saudis, the Emiratis, the Kuwaitis, and the Iranians aren't making their sustaining capital investments. They need the money for other purposes, like killing each other. And they aren't making sustaining capital investments in facilities that are going to be blown up. In addition to that increased deferred sustaining capital investment, we need to repair or replace all of the producing facilities that have been war damaged. So the circumstance that you and I had described in January as being things that would affect the market in 2029 have become exacerbated, and people need to know that. The solution that I talked about on your program in January was either the U.S. super majors, in particular Exxon, but it was less challenging for me to recommend Exxon at 85 or 90 than it is at 180 or 185. And then, for people who had the courage of a bad balance sheet, Occidental or Chevron, but in particular, a package of Canadian mid caps. The first thing to talk about in terms of that recommendation is that the one that I identified as my favorite, ARC, turned out to be the favorite of Shell. And so ARC no longer exists as an independent company. It's going into Shell. But the rest of those recommendations are intact. I think it's also fair to say that Carney hasn't been as much of a disappointment as I had feared. He still says these things like all his financial decisions will be based on carbon, um, small compensation to Canadians at the pump. But I think he's pragmatic enough to know that his idiotic budget needs funding, and he needs to allow the oil business to make some money so he can steal it. That sounds like a very cynical point of view, but it's my point of view. And I suspect that Mr. Carney will be less bad for the oil industry than Mr. Trudeau has been. So I would encourage Canadians in particular, although this might not be the right moment, to consider the fact that Canadian oil and gas companies are systematically undervalued. And they're systematically undervalued because of the Globe's belief in the political risk afforded by Canadian political leadership. And your political leadership is probably a little less bad than people think. By the way, I'm no fan of American political leadership either, but this discussion has been about Canadian oil and gas companies. And contrary to the belief of your prime minister, he isn't running against Trump.
This is very helpful because I think people are looking at what's going on in the oil market and wondering, all right, well, should I be involved? To what extent should I be involved? Where should I be? I wonder for you, are you happy with how your portfolio of oil stocks is set up right now? Because I remember you were still, I think you were mostly established in your position, but there were still some things that you wanted to buy when we had spoken in March. So how are you feeling about your setup right now?
There's one little subset in the oil and gas business that I'm not fully invested in, and I don't know whether your readers should be invested in it or not. It's highly speculative. The only avenue of hate left in the oil and gas business that I saw was conventional exploration. The investors want, shale basins, and conventional exploration has been grievously underfunded. Offshore has been underfunded. So I want conventional exploration offshore because those two things are hated. And I want emerging and frontier markets because that's hated too. So I've looked at 31 small companies, sub 500 million market cap. They're involved in conventional exploration, mostly offshore in frontier and emerging markets. And I developed a shopping list of 5 companies. and I've been trying to fill the allocations in my portfolio. The oil price has not helped. It has propelled even the hated penny dreadfuls higher than I would like. We will, at the conference, whether I'm full or not, reveal the names of those 5 companies. But I don't want to do it today, Charlotte, because I don't want 30,000 of your subscribers competing with me on the bid.
I think that's fair enough. So lots going on with oil as we can tell, but the Iran war has really raised concerns about a wide variety of commodities in terms of supply chain issues. Many things that people would not normally be thinking about now are rising to the fore. So aside from oil, when we're looking at the Iran war, what would you highlight as something that we should pay attention to that's come to the top here?
A variety of things. About 35% of the world's export supplies of refined aluminum come through the Gulf. This inures well to the benefit of Canada. Canada's an aluminum exporter. And to the extent that this continues, that will inure to the benefit of Canada, but the detriment of the world. Most importantly, I think the Gulf region is the world's largest exporter of nitrogen and nitrogenous fertilizers, and also of sulfur. It's too late to impact the planting season in much of the northern hemisphere, which means that we will see higher food prices. The green revolution is really a function of the application of nitrogenous fertilizers, and the northern hemisphere planting season is far enough along, and the fertilizer supplies and prices have been impacted enough that there's no way that we're not going to see higher grain prices as a consequence of this. Whether or not we see higher grain prices running, 2 years in a row will be a function of the loadings in the southern hemisphere and what we're able to do in the northern hemisphere next year. In the absence of nitrogenous fertilizers for 2 straight planting seasons in the northern hemisphere, we have a serious circumstance. I'm not saying it's going to occur, but we have a serious circumstance. Another impacted market that's a small market is helium. And this inures really to the benefit of Canada. Canada has vast helium reserves, thus far undeveloped because helium from the Persian Gulf, from Qatar in particular, is so cheap. But the implications in particular for the Saskatchewan helium industry, the need for helium producers, helium consumers, particularly in high technology applications in the United States, could have profound implications, albeit in a very small industry, the Saskatchewan helium industry. The implication that I'd really like to highlight, though, in this interview is in the uranium business. The great period of uranium plant construction in the 1970s occurred as a direct consequence of the Arab oil embargo, when energy security on a national basis became a particular concern. Both the French nuclear fleet and the Japanese nuclear fleet, the fourth and third largest nuclear fleets in the world, were constructed largely as a consequence of the energy insecurity those economies felt as a consequence of the oil embargo. That lesson has been relearned in earnest. People have been concerned about the supplies of energy, the strategic supplies of energy for a very long time. They have been concerned about price. But those lessons have been relearned, particularly in Japan. 5 years ago, post-Fukushima, popular opinion in Japan was 75% against nuclear. Popular opinion in Japan, according to the latest poll, is 72% in favor of nuclear, a sea change in support. Uranium is the only fuel dense enough that, as the Japanese point out, they can store enough of it in one warehouse to power Japan for 5 years. You can't store that much oil, even if you could buy it. And the true beneficiary, if there's a beneficiary of this war, will be uranium and nuclear power. That's something that all of your investors should understand. This isn't something that's going to play out over the next long weekend. It's something that's going to play out over 3 or 4 or 5 years. But the truth is, Charlotte, and you've learned this during your duration as a commentator, is that money isn't made in 2 or 3 months. Money is made in 2 or 3 or 4 or 5 years. That's the way things work. And people really need to be looking at uranium, looking beyond 2026, maybe beyond 2027, at the inevitability of much higher uranium usage uh, in a commodity where supply is already less than demand.
Very interesting for people to be watching. What does that mean for your approach to uranium right now? Are you established at the moment? Does that mean you'll be out looking for new opportunities? How are you looking at it?
I'm a very large shareholder of Cameco. I mean, listen, I'm not important to them on their shareholders list, but they're important to me in my portfolio. And for most people who aren't prepared to work hard and really understand smaller companies, a uranium portfolio could consist of the Sprott Physical Uranium Trust and Cameco. That's a no-brainer portfolio, and it's a portfolio that if you hold for 5 years, you're almost certain to do very well on. If you're a Charlotte McLeod listener, if you're willing to do more work, to inform yourself more, if to tolerate more volatility and cyclicality, coming down the quality trail, coming down to the next gens and the denizens and the paladins of the world is something that you should consider. Um, you have more risk associated with your reward, but for reasons that we can talk about in another interview, we don't have time today. Those risks are very, very, very worth taking. A lot of things have changed in the uranium market in the last year, and I suspect that it'll be an extremely fertile place to play over the long term.
Right. Well, we'll leave uranium there for now. We'll have to come back to it in more detail at a different time. While we're talking about the Iran war, I think I have one final point that I want to go over there. You're talking about how it's interestingly it's resulted in this strength in the US dollar, at least in the near term. But I know over the much longer term, you've talked about how it will lose 75% of its purchasing power. So can you talk about how those elements interact with each other and what timeline you're now looking at for that to happen?
Uh, I don't see many things changing in terms of long term. Obviously, I hadn't anticipated war. I had anticipated that if the political class left the interest rate alone, that it would rise. I didn't anticipate that the political class would leave the interest rate alone. It would seem now that the U.S. Fed still has control of the 2-year rate, but the longer rate, it would appear that they don't have control over. The market's beginning to reassert control over the long rate. This will create problems for the U.S. We have almost $40 trillion in debt at the federal level to service. And this higher interest rate means that more of the money that we don't have goes to service the debt and less of it goes to fund the things that we seem to find it necessary to fund, like wars. This is not a good combination. I think it's likely that the voters and the political class will ultimately insist on lower interest rates, which they will have to accomplish both by, well, mostly by printing money. The only way that they can bring the long rate down is to buy the long bond and increase cash. And you can't buy the long bond with money that you don't have. So you have to create that money. You have to print it. That means that in order for lower interest rates, you have to have quantitative easing. Quantitative easing is what they call counterfeiting when the government does it. And that is very, very, very hard on the purchasing power of the dollar. Creating more false currency units does not enhance the value of the existing false currency units. And artificially low interest rates that are substantially below the rate of deterioration of the dollar is bad for the dollar, but good for gold. And that's the sort of truism that your listeners need to understand. In the near term, the higher interest rates are likely plateauing or causing the gold price to decline. In the intermediate and long term, the political implications of high interest rates likely can't be stomached by societies in as much debt as the United States and Canada. And I think the political class and frankly the voters will insist that we do something stupid and manipulate interest rates down, which is very good for gold.
I think yes, this is a good pathway over to gold, which of course we also have to talk about. For you, recently over the past months, there's been a lot of focus on how the Iran war is impacting the gold price. So I've been hearing a lot about that. What do you think is the main driver of gold right now? How important really is the war in the grand scheme of things?
I think it's very important. The war has caused people around the world to be nervous. And despite the evident weakness of the US government, the world's preeminent reserve currency is the US dollar. So perversely, the war has made the US dollar more attractive. In the flight to quality, the private sector, if not foreign central banks, still instinctively goes for the US dollar. In addition, the war has forced up US long term interest rates. And the higher interest rates in the US relative to other currencies has brought more money into the dollar. Gold is denominated in dollars. A more expensive dollar yields weaker gold. Our mutual friend, Doug Casey, laughingly says the US dollar is the worst currency in the world with the sole exceptions of all of the others. And the last 90 days has certainly proven that to be true. I'm not suspecting, Charlotte, and I think I've been consistent in my interviews with you in saying this, that the US dollar will do poorly compared to other currencies. I think other currencies will do at least equally poorly over the next 10 years. So I'm not suggesting, as an example, a swap out of the US dollar for the Canadian dollar or the euro. What I'm suggesting is that during periods of time when nominal interest rates in various currencies don't compensate you for the deterioration in the purchasing power of those currencies, gold does well. And I suspect that gold will weather the storm better than currency investments. I'm not suspecting that the purchasing power of gold necessarily goes up. I'm suggesting that it maintains its purchasing power while your Canadian dollar savings and my US dollar savings over time reduce our purchasing power.
Yes, it makes sense. And I think certainly you've been consistent with that message over time. For gold, I've got one more question on gold, which is where would you place us in the cycle right now? I'm also seeing a lot of questions after the big run up at the beginning of the year. We pulled back and people are wondering what happens next. So, how would you see that in terms of the cycle?
I've been asked repeatedly to quantify the gold bull market as a baseball game and talk about what inning we're at. I'm not really a baseball fan, but I'm going to guess we're in the sixth inning. I believe that the gold bull market began in the year 2000. Many people feel differently, but in the year 2000, gold was at $253 an ounce. So gold has risen approximately 20-fold in 26 years. I think the gold bull market has at least 10 years left to run. If we've had a 25-year bull market and it has 10 years left to run, it makes some sense that we're in the sixth inning or the seventh inning. I don't think. Well, let's look backwards. In the year 2000 to 2026, uh, gold priced in U.S. dollars has risen at about 9% compounded for 26 years. Pretty good performance, by the way. I think that performance likely continues. Specifically, I think if the US dollar loses 75% of its purchasing power over 10 years and gold maintains its purchasing power, it stands to reason that the nominal price of gold, which is, say, the US dollar quoted price of gold, at least doubles and probably increases threefold. That's very consistent with the experience that we had in the decade of the 1970s, the last time the US dollar lost 75% of its purchasing power. In truth, in the 1970s, the gold price ran 25-fold. But you must remember that it ran 25-fold from price controlled levels. Given that it's already run 20-fold, I suspect that more modest goals need to be in place for gold. And I'm not suggesting necessarily that people speculate in gold or even invest in gold. I'm suggesting that people do as I've done and save in gold, that they buy gold merely to maintain their purchasing power.
Of course, we have to also take a look at silver, which is another one that we've been talking about in many of the recent past interviews. So, if we look back to January, I believe you'd said that the speculative outlook for the silver stocks was better than it was for silver itself. So, want to check in, see if that is still how you're feeling about silver and the silver equities.
Well, with one exception, that thesis has played out well for me. As you know, Charlotte, I sold about 80% of my physical silver, and I deployed half the money in silver stocks in a basket of 7 silver stocks. 6 are up nicely. One, Vizsla, through no fault of silver, but rather operational difficulties where 10 of their employees were murdered, fell. I believe that thesis to be true to this day. I think if the silver price rises, it'll be good for the silver stocks. If the silver price goes sideways, interestingly, the silver stocks are priced in the market as though silver was at $42 or $45, but it's not. It's at $80. So interestingly, the silver price can go sideways and the silver stocks can still do well as a consequence of their discount. And more perversely, if the silver price falls, there's room in the silver stock valuations, given that they're priced at discount $45 silver. If the silver price falls, I think the silver stocks fall less precipitously than the metals. So from a speculator's point of view, I personally would prefer to be in the silver stock market rather than the silver market. You'll remember, too, from our earlier interview that when I sold that silver, I deployed half the money in the silver stocks. I deployed 25% of the money in oil stocks. As a hate trade, the hate trade's over. You know, people don't hate oil anymore. The war has caused them to, if it's the right phrase, love oil. And I put 25% into savings, about 20% into physical gold, and about 5% in short-term U.S. Treasuries. That part hasn't changed. I have been trying of late to increase my liquidity because I'm concerned about the potential impact of the war and interest rates on credit markets. And I'm concerned about the fact that we could have a liquidity squeeze, a confidence squeeze. And in a liquidity squeeze, you need liquidity. I'm done raising liquidity now. I've got all I need personally. I don't know that your viewers have all they need personally, but I have all I need personally. And I'm going to start being speculative again. My own portfolio is very adequately weighted, the very, very high quality companies, the Franco-Nevadas of the world, the Agnico Eagles of the world, the Exxons of the world. Where perversely I'm underinvested is the sector I cut my teeth in, which is the sub $250 million market cap explorer or developer. And that's where I'm going to be allocating more of my own capital in the next 90 days, assuming that the opportunities present themselves.
Right. So, assuming we do have that liquidity squeeze and it creates an opportunity for you, you're going into those smaller companies. Is there anything else you can say about where you'd be looking in terms of commodity or anything you could mention there?
I need to clarify what you just said. I'm going to be allocating to speculation irrespective of the liquidity squeeze. If a liquidity squeeze happens, I'm going to see what falls most. In other words, I'm going to recalculate everything. If I could get Exxon on a 50 or 60% off sale, or Cameco on a 50 or 60% off sale, I'd be on that print like white on rice. I'd stop speculating. I'd go for the best of the best cheap. Relax. You know, um, where I mean, for most of the time that you and I have been interviewing each other, Charlotte, I've preached by hate. And there's not much hate left in the resource markets. I think the easy money has been made. I think the sure money is in front of us. As an example, I think almost no matter what we do globally, with the exception of a depression, that the copper price has to rise because we're going to use more copper than we produce. You're going to have to ration it by price. Uh, if we didn't have a war, the same would be true about the oil price. I think that the gold rise is inevitable, but none of them are hated. The circumstance where you and I talked 6 years ago, and I talked about the fact that all of the social media comment about silver was negative, and so the silver price had to go up. Well, it did. So the hate trade is gone. But the certainty with regards to increased commodity prices as a function of decreasing supply and global demographic growth is very much intact.
That's very interesting because I was going to phrase that question as what is hated right now in the resource sector. But so at this point, there's no real hate left for commodities. Is that how you see it?
No, no. I mean, for speculators, there's still some hate left in places. People, for whatever reason, hate Congo and they hate Brazil and they hate Bolivia and they hate anything that ends in Stan. And so I'll likely be speculating in those places. I wouldn't describe that as investing. I describe investing as a is a financial financial operation where you allocate capital based on probabilistic uh, returns on capital employed. I regard speculating as less than 50% certainty in terms of outcome, but with outsized returns. And so make no mistake, when I'm going into a market like Congo or Sudan or West Africa or Bolivia, I'm speculating, but I'm a speculator. It's what I do.
Makes sense. And just going back to the silver stock. So I was going to ask you if you'd made any changes to your silver stock holdings since we talked earlier in the year. It sounds like not. But then I also wanted to, because you're talking about Vizsla Silver and the tragic incident that happened there. There's been a recent development there with Elemental Royalty announcing plans to acquire Vizsla Royalties, which owns the royalty on the Vizsla Silver project. So just wanna that's a little bit specific, but how do you like that transaction? Do you see it helping the company? What are your takeaways there?
I think that that deposit is important enough to Mexico that it gets built. I'm not sure that it gets built on the short-term basis, but I think it's the fourth or fifth or sixth best undeveloped silver deposit on the planet. And so I think it gets built. I don't know how it occurs, but I think it gets built. I think the decline in both Vizsla and Vizsla royalty enabled the elemental royalty people and their backers, Tether, pardon me, to get a superb royalty at a price that was at once a substantial premium, 30% plus premium to the then share price, but also likely becomes accretive to the elemental shareholder. In other words, a true win-win. It also diversifies the risk. I was a decent sized Vizsla royalty shareholder. And in that circumstance, I had all of my investment tied up in the politics of the state of Sinaloa in Mexico, which is occasionally disquieting. Now, I own that interest in a company with over 200 royalties worldwide. So the percentage risk I run as a consequence of social unrest in Sinaloa is much lower. So I'm happy. I was a big shareholder of both. So I'm happy.
Okay, okay. Thank you for sharing on that. And one more follow-up here. So you mentioned Tather's involvement in Elemental and in other places of the royalty space as well. I don't think I've asked you. I've been asking a lot of people their thoughts on this involvement from kind of an outside player coming into the gold space. What are your thoughts on that? Do you like that involvement? How do you feel about it?
I do. I only know one of the Tether people, and I don't know him particularly well, but I'm very impressed so far. I'm impressed about the fact that they've built one of the world's largest financial services businesses from scratch. That's that's extremely interesting. I'm interested too, talking to them about what they're doing with their own money, because it's important to note that Tether, uh, they're major shareholders. They aren't creating a stable coin out of prospect generators or royalty companies. They're using the money that they have left over from the interest on their U.S. Treasury holdings and the tiny management fee that they get on their gold to, in effect, buy these stocks with their own money, which is important. They see the ability in the royalty space. They see the valuation discrepancies between the third tier royalty companies and their market cap relative to net asset values and the cost of capital or the valuation discrepancies for the Franco Nevadas of the world. And they see that the little ones relative to the big ones are cheap. and they have suggested that they will invest in the sector until either the arbitrage goes away, or they will combine the third-tier royalty companies to create a tier one royalty company, or the big guys will acquire the little guys. And I like that way of thinking. I like the fact, too, that the royalty companies, the little ones, at least the well-run ones, have a new champion, and a rational champion. A shareholder who, if they're making a mistake, will say, you are making a mistake, and will likely punish them if they continue to make that mistake. I like, too, the fact that there is the possibility for horizontal amalgamation, which is to say mergers in the small space. That often doesn't happen because in a merger, one management company must lose, and no management company wants to sacrifice their salary to the well-being of their shareholders. Having adult supervision in the space, powerful adult supervision in the space, looking after their interest, and as a consequence of that, looking after the interests of other shareholders, I think is a very good thing. This is committed capital. This is capital that believes that gold royalty is undervalued, that Metalla is undervalued, that Elemental is undervalued. And to the extent that these companies have opportunities to acquire royalties or participate in streams, I suspect that Tether will be lead orders, which will mean that they will have the ability to raise the capital to grow, which hasn't been certain in all markets.
Well, thank you for sharing. I found it really interesting. Hopefully the audience also is interested to see what's happening here. And I think we can start to wrap it up. I wonder if you have any final thoughts that you would want to leave investors with, either on the symposium or anything else that's on your mind at the moment.
Well, with regards to the symposium, I've made it no risk for you. If you attend live stream and you think for any reason whatsoever I didn't give you your money's worth, I'll give you your money back. Yes, you've wasted 4 days of your life, but hopefully you've learned a lot in those 4 days, and that 4 days makes you a lot of money. Much more likely, you will think you got your money's worth, and you will learn enough at the symposium, and by combining lessons at the symposium with the free lessons in the Rule Classroom, that your investment performance will improve. Um, that's important. The way you make money is by applying yourself in markets. We're giving you the opportunity to do that. But I'll give you a way to do it for free too. As I've done so often, Charlotte, any of your listeners who like what I have to say about natural resources and want to personalize it may go to another of my websites, ruleinvestmentmedia.com, and list their natural resource stocks. I personally, for free, will rank those natural resource stocks, 1 best, 10 worst, and I'll comment on individual issues where I think my comments might have value. That's ruleinvestmentmedia.com. Once again, please no tech stocks, please no crypto. Leave an old guy to do what he does well. But that's the best offer I can give. 50 years experience applied to your portfolio for free.
Perfect. Well, we will have those links in the video description for people to check out. Thank you so much for coming on to go over what's happening in the market, and looking forward to the Rule Symposium. Thank you very much.
I'm really looking forward to hosting you in Boca Raton. I think that's going to be a really good time. And I hope that many of your listeners join us, on the live stream. We hosted over 1,400 people from 33 countries last year. We're looking to host over 3,000 people this year, and we're going to give them a great experience.
Well, that number sounds like a sign of the times. So thank you again for coming on. Once again, I'm Charlotte McLeod with investingnews.com, and this is Rick Rule. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.